Hello everyone and welcome back. In today's video, we discuss the stock, crypto and commodities markets in what is going to be an incredibly pivotal time for markets across the world. We have big support being found here on the Nasdaq and S&P 500. We have the long leg doji being indecision at the support. And now the next 24 to 48 hours are going to define possibly the next couple of weeks of trade. So will it be bull? Or will it be bear? We'll try to answer that today in the video. Stay tuned, this one's going to be good. So welcome back everybody to our market recap for the 22nd of Feb 2022. And this, of course, is our daily show where we cover off on stock, cryptos and commodities. And if you like any of those things, make sure to subscribe. And of course, if you enjoy the video, smash that like button. It does help us out. Now, what was happening on the most important market in the world, the US market? Well, Tesla was getting beaten down 4.14%. We'll take a look at that later in today's video. We also said Home Depot not doing so well. We had Nvidia showing some signs of weakness. Remember, that is coming off the back of two very bearish weekly candles. And in general, it was mostly technology getting attacked. Let's have a look at what was happening on the indices though. Well, it was really just more of the same. The buying in the morning, the buy the dip philosophy that many retailers have. The first hour is obviously where retailers trade. There was a buy the dip followed by a sell, that rip, and then of course a little bit of a pull up followed by a sell off right into the close. And I think what's most telling is more the sectors that were doing well on the session. We saw that things like utilities, healthcare, REITs, financials, consumer staples were on the top of the leaderboards in terms of the sectors that lost the least. And this becomes really important when you understand the market dynamics. Remember, most big funds have to be invested in a big pie circle and they have to always have certain portions of equities. So when they're grabbing, let's say, defensives, it could show us a sign of what's happening in the next couple of sessions. And when we bring that with the technical analysis, I think you'll see why. So most people are discussing this as a correction. Some people are talking about it as a crash. Some people are talking about it as a recession. This is normal. Whenever we experience fear, all of the different types and styles come out. But what actually happens when the S&P 500 closes in correction territory? So generally, correction territory is defined between 10 and 20%. From top to bottom. When you get past 20%, you enter a bear market. And in between this period, we're technically in a correction period. Now, I think the closest period of time that's similar to now is probably going to be 2018 because we saw rate rises around that time and obviously some instability in the economy, all sorts of things going on. Now, what we've already seen here is basically we've hit this level before on the stock market. The S&P 500 has come down, hit around this level and bounced up. So we've already seen that 1-2 week play out, which is usually a nice bounce. Guess what? It's exactly what happened. We call it the dead cat bounce. But it's what happens after that that's more interesting. If we go with the stats here from the November into December sell-off, it ended up lasting another 3 to 4 weeks, which is probably in line with what we expect. Remember, what the Fed is doing is the Fed is about to make a big announcement. Obviously, they will raise rates in March. Everyone knows that. How much, we'll find out. And it could be really a buy the news, as in buy the fact. What is going to happen is the Fed's going to raise rates. All of a sudden, the market will have some type of clarity. And remember, it is in the best interest right now for the Fed to create volatility. It works perfectly in with their really only get out of jail free card, except for the potential recession that could be happening due to inflation. So let's just talk about some of the macro kind of things that are going on right now. Now, a lot of you are concerned about housing. That always comes up. And they are interconnected markets. So whether you like stocks, housing, bonds, it doesn't really matter. They're all connected together. So we've seen a massive increase in housing. I mean, you can see here since the 2020 pandemic, really the acceleration of housing speculation has come through. And it kind of reminds me of what really happened here. So during that 2001 to 2006 kind of run, we saw a lot of speculation in the US housing market. And eventually this will become a bubble that ends up popping, similar to last time. It's just the way markets work. You saw, of course, even back here, even though the chart doesn't go past 87, there was a lot of speculation. All of a sudden, the US enters a recession. So these things come time and time again. But think about what happened here. We've got a period between this time, then we get a little bit of a blip. Then we have another period, then we get the big one. What have we had? We've had a period, that's pretty good. In fact, getting back to kind of those previous highs, which makes sense. We're going well over a decade past at that point. Then we have the blip, which was very short-lived. We inject more money into the system, and effectively it begins this roller coaster. Now, what we're not seeing currently is necessarily bad debts in the same way that we've had them in the past. So this period here and this period here. When we get household mortgage debt as a percentage of GDP expanding at an incredible rate in the US, that will be a concern. It is happening in other countries, but not the US so far. I also think it's worthwhile when we consider major events. A lot of people are freaking out about what's happening here in Europe. The time it will tell here that yes, there can be a little bit of weakness, maybe for a couple of days to 10 to 15 days. But in general, statistics would show that the US market can recover from most of these conditions fairly quickly. So I think this is more of the inflation or overvaluation of the stock market and that actual bit of news that we should be looking at than more so the day-to-day things going on here. You may disagree with me, but that's how, I'm looking at it. You got to cut through this news. And if you keep flip-flopping in terms of what the news is doing, that's more of a day trader technique. But if you're thinking about it from an investment perspective as well, it is totally different. So do remember that. Now, the Fed and the market tend to be wrong with each other. So right now we've got the market over here saying, yes, rates are going up. Obviously not 4%, but you know what I mean? 2+. And then you've got the Fed kind of going, yeah, we might do it. So I think somewhere in the middle will probably be where they end up meeting, because the real interest rate is going to be different to what it used to be. That's something that could be seen as a positive in the markets. Just remember, throughout all of history, generally the market and the Fed have not been on the same path in terms of what they've done. I also brought up this chart previously, which was talking about the 2% inflation target, and the Fed has done a miserable job of being able to keep that target over the last decade. This big inflation that's just occurred in many ways is really just going back to what the long-term trend line is. So before we go and start freaking out, we need to put it all in perspective, because remember, if the market keeps dropping, you're going to either need to get those diamond hands out and start to potentially invest in opportunity, or you're going to become very fearful and convince yourself that there's an epic crash coming. A lot of people are convincing themselves. Obviously, we continue to see investor sentiment drop. This is normal, and it always does seem to happen throughout time. And we've talked a lot about what ends up happening after rate hikes. When you do tend to get rate hikes, often it's a real by the fact in terms of when that information comes out. Seasonax also would be pointing towards something similar, having some kind of weakness this first quarter, the Jan, Feb, March period in midterm election years, and then a nice middle of the year in terms of some recovery there, and a possible double dip scenario later on. If we're looking at raw stats, that's what's shown. But let's get into the actual technical analysis, and we'll start here with yield curves. Now, anyone that's not aware, yield curves are pretty important. Everyone in the market, all big investors, look at one thing, and that is inverted yield curves. It is a canary in the coal mine in terms of showing weakness in the economy, where there is a high chance that in the next couple of years after this occurs, there will be an epic crash. We're not there yet, but we've been there every other time. Dot-com boom, 98, 2000, it inverts really hard. And then that becomes, obviously we have the 89 period, we have the 2019 period, 18, and of course the GFC itself. So most people are looking at this. If you see it, you have to pay attention to it. I certainly do not pay attention to it. It becomes very important. Here's another thing that we like to do here on the channel, which is the S&P 500 stocks above the 50-day moving average. You always hear this idea of when there's a lot of fear in the street, then it might be time to, of course, be buying. And one of the ways that you can couple your technical analysis supports with an interesting zone is just to think about how many stocks are above and where traditionally they've purchased up. So in most of the bigger dips, we've actually seen the stock market push so far down that it goes to around a 10 or 8 to 10% level of stocks above the 50 moving average. So that might be an interesting zone. And it shows so many great dip levels were purchased off this particular indicator. So just remember to have something like that. It can help you with your trading. So we saw the VIX spike as we suspected. It spiked straight into our 32 level, which has been our resistance now for a while. The only way this level will break is if we end up getting new lows on the S&P 500 and NASDAQ, and that hasn't occurred yet in terms of a closure. We're also seeing bonds doing a different thing. So bonds have been declining for a while, but all of a sudden, we've now got 2 weekly bullish hammers here and the potential for a bit of a follow through. So if you think about previous times, we were talking about 2018 before, all of a sudden the bonds started to actually go bullish. And this is partially due to rotation. Sometimes the bonds can show us when the market's getting fearful. And remember, we're just at support here on the stock market. So if it breaks through, where are a lot of funds going to go? They will traditionally tip into bonds, at least temporarily. And that's what happens most times. You can see it over there on the left during the pandemic. Now, we do also have a resistance here of the 20 moving average. So really, this is showing that if we breach this level, it's probably going to happen at the same time that the stock market would go through support. And all of these markets, as we always say, are interconnected. And that's what's really important. So stick around as we see all of these markets and how they interconnect. We do this on a daily, all the time. Gold continues to do quite well, 1910. Congrats anyone that's been actually trading gold. Well done. You have achieved the first or second target in this case. So 1870 first target, next target 1910. If you've been following the channel for a few weeks, hopefully you can see how technical analysis works so well when you find correct levels. Look at that. Beautiful hit, rejection. Beautiful hit, consolidation. This is exactly what you expect on a market like this. Gold, next stop, if it does breach through this 1910, and then of course get a little bit of consolidation above that or a nice pullback, is 1960. And then past that point, you're probably looking at all-time highs on gold actually. So it's getting through these resistances. There's been a lot of haters on it, fair enough. But you can look at a whole bunch of others. Like we've talked about palladium. We've talked about like there's people are trading aluminium right now in aluminium stocks or aluminum in America. These types of things are doing quite well. And this is a materials time. So you might think there's no way to make money. In inflationary periods, often materials are the way to go. Just go back and study history. You'll see what ran the best. Materials. The ASX 200, the country I'm from, Australia, it went bonkers during that period because we have so many mining companies. They did incredibly well. So if this inflation continues and you believe that, then you don't have to hate all stocks. You can potentially like materials. So I think there's always an opportunity, and Wall Street certainly is cashing in on that. You'll see if you go look at some of those stocks, they're moving hard right now. Let's talk about the 4-hour and weekly here for US oil. This is still really a no-go zone in terms of the way I see it, because of course we have the tensions in Europe. It's up, down, and all around. And I've kind of talked about how I think it's kind of tapped out. And the main reason is always going to be here with the weekly. The weekly 20 moving average, oil's a little bit far away. Historically, that has meant it's weakening, and it is continuing to spike due to news and then reject. So be careful here. You'll also notice all of the mainstream media is like oil booms and oil explodes, and we don't want to fall into that trap. It's not, what is the price action telling us? It kind of sucks. So if we're looking at it and it kind of sucks, don't listen to the media, listen to your brain and your analysis and what the psychology of the market is telling you. That's the cool part. Let's talk about psychology on Tesla. Gotta say, Tesla fans, I'm not loving it. I mean, I hope we're proven wrong here, but let's have a look at it by the actual technicals. First technical, big trend line we've used correctly to pick up levels in the past. And we've been bullish on Tesla all the way through this trend line. It's underneath on the daily. Not good. We also saw that 950 area last week not hold up. A rejection candle. Again, we're seeing this commonly through the market here. And now we've got the long leg doji right on the 50. So remember, the problem with this 50 is think about this 50 also on the way up. 50, buy. 50, buy. Where are we now? 50. This is the second touch of the zone. Historically, it's touched it and purchased off. It is looking weaker than it has in quite some time. And if we breach underneath the 800, the next target, well, we'll have to really try to figure it out. I mean, it's probably going to be 700 from the next level. Tesla will probably jump in $100 increments, but be careful here on the charts. It still remains a very good technical trade from the day trade perspective. If you were looking at it in the previous session, there was a great little bounce off here. Beautiful tweezer trade, nice follow through, really good like into the close of the session. And what I like at the moment with Tesla is usually like those close of day or res sup hits. And if you get those types of things, they look very, very good. So at this stage, it kind of looks weak. I'm not sure if it can get through in terms of go to the bull side. That's going to be determined by the market more than Tesla itself. But of course, you're looking for it above the 860, above this big long leg doji. And if that happens, okay, cool. We can go back to 950 and you'll feel good. Very important 24 hours here on that stock. And speaking of stocks, let's just go around the world here on indices, sectors, everything. Let's get into that portion of the video. First up, the DAX still looks horrible. This is basically a Wyckoff in many ways. We have those maximum pain kind of levels. We obviously have broken on the daily below the previous lows. You can see here how big this level was. And this was forming since April of 21. It kind of reminds you a little bit of IWM, I'm sure. So that's weakened. It's then re-picked itself up, and any of these kind of previous supports you would think going to act as resistance. So we're at the paramount kind of time for bears to take control of a market like this. If we look at the US, another thing that's not doing well is the industrial sector. It's just broken almost to a new low, but certainly broken through its previous body closures. This is the worst body close we've seen on the daily. Another Wyckoff style candle formation, or in terms of, big, long kind of trend that's looking weaker. The distance here, if we take it, is basically pushing down to the previous resistance. And it's another signal that the market's weakening. Look at the weekly as well. I mean, I don't look at this and go, oh, I love these candles. They look super bullish. They just don't. And the price action, it's telling us something here. It's saying, it's looking a little bit scary, guys, in comparison to what you usually see. IWM, we've talked about this one as well. Again, weakness off the roll reversal. Here's the Wyckoff. Of course, we had that breakout, which looked real and then turned out to not really be that way. It's why you trade these breakouts with hopefully a stop loss, take profit in mind, which wouldn't have been hit, and of course your entry. But in this case, we look like we're going towards the weakness, and we've had that leg discussion. So basically, some people will call it an ABC, some people will call it waves. It doesn't really matter. The main point is they're very similar in length. And if we take those distances, it points into the weekly 200 and previous resistance. So think of this as the lifeblood of the US market. If the small caps do poorly, it's really saying that there's a reprice coming across the board. And that has broken below the last swings. And if it keeps following through here, I mean, you know that the weakness really is ensuing. Now, here's where the bulls might be able to take control. And that is the major indices. We have long leg dojis. Now, a long leg doji for any first time viewer is a high, a low, an open, and a close at a very similar level. They usually happen at a key point of support or resistance, and when they do occur there, it shows indecision of the market. So it basically shows that you have a big tick box, you've found the correct level. If it breaks to the high side and closes above, then you have a bull signal to at least go long on the next session. If it breaks on the below side, you generally have a bearish signal to go short. And where has it formed? Right on the support here on the NASDAQ. So I think that what we're seeing here on the NASDAQ is weakness. We are clearly seeing a series of higher lows, lower highs, for now. So what that means is that it is currently showing a trajectory to the downside. And if it ends up going bullish, well, so be it. We'll have to then trade it. It makes the right area or makes the right sense. But if it goes bearish, we have to watch out below, because that begins a potential here for a much bigger transaction towards the short. So we'll use the S&P 500 to show that. And we'll go back through a little bit of history to kind of figure it out. So the first thing is obviously the head and shoulders that everyone's talking about. Left shoulder, head, right shoulder. That points towards the 3,800. Now, I mentioned that some big investors or some big investment firms seem to be sending out little secret alerts to people saying that they expect these prices to be very possible, and they're looking at them with great glee in terms of potential purchases later on. Now, that doesn't mean it's ever going to happen, but it's interesting to see they've changed their mind. People are downgrading the S&P right now. Goldman's changed their target to like here. Everybody else is changing their target into here. So by the end of the year. So it's interesting to see that we're slowly but surely showing a little bit of decline here in sentiment. If we go back over to previous times, let's go back over here to 2018. At that point, what happened was we had support. We actually got a little buy here, buy hammer, but each day was bearish. And that was the clear tell here. There was never a bullish day follow through. It was bearish, bearish, bearish. And when you understand price action and you've been doing this for a while, the key was in the closes. Nothing could hold up. And then all of a sudden it went through and it was incredibly brutal, incredibly quickly. The market actually ended up dropping a further 12% here on the S&P 500 in only a few sessions. In fact, it was only a week or 2 weeks. Now think back to the information at the start that we went through and that weakness that may ensue. Remember, less like kind of 2 to 1 month seems to be that kind of point. So if this does drop through, it could be brutal quickly. And I think that's something that we need to be aware of in these markets. Bear markets are faster, or at least correction markets are faster than bull. Everybody knows that. And it could be really setting up for something a little bit sneaky when it comes to those. Another thing somebody wanted me to look at was NASDAQ versus the S&P 500. If you check it out here, it just really shows how much better the NASDAQ has performed than the S&P, but it's an interesting kind of correlation here between growth and necessarily more defensive value side. So if we breach through, obviously what this is telling you is that the NASDAQ is much weaker than the S&P 500. So you'd probably expect that as the bigger percentage trade, not really showing us too much more than we already know. Bitcoin, there's not much to analyze here. Really, Bitcoin's going to move with the market. We've seen it follow the NASDAQ several times. If you're looking for the big key support, well, it's going to be down here at the 30,000 level, and you're looking for wick purchases off this. You don't really want it to go down here and close a nice body. You want it to kind of go down and show buying momentum. But we are not seeing positivity on the crypto market just yet, but we'll continue to follow it as much as we can. Remember to follow us over on Twitter. Many of you have done so at FX Evolution. We post a whole bunch of helpful charts there and everything else. And if you enjoyed today's video, please remember to subscribe, smash that like button, and we'll see you in the next one. Bye for now.